Hey everyone, it's Paul with another Tuesday YouTube video. All right. Today I want to talk about something that looks so extreme that I don't know. It definitely looks like something's about to pop and go in a different direction when everyone is generally on one side of the boat, of the lake. Yeah, generally, when you look back, you don't want to be on the side that's crowded. You want to be on the other side. And in a moment, I'm going to tell you what I'm talking about. But first, let's quickly do some legal stuff, which is that this YouTube video, any of the content from ATG Digital Media, which is my company, is not investment or financial advice. You're responsible for all of your actions and your money. Past performance does not equal future results. Errors, mistakes, oversights, yeah, they happen. Capital loss is a potential and likely outcome that you should think about before you do anything. The owners, contractors, employees, associates of ATG Digital Media, we own, trade, transact in the investments that are mentioned in our model portfolios, updates, all the content. If you want to check out ATG Digital Media, I don't really know why I do this because truthfully, there's not always a lot of sales impact on Tuesday, but nonetheless, I should just, give it a shot, right? Paid subscriptions begin at $9.99. We focus on innovation and growth stocks and crypto. And with a subscription, you get model portfolios, stock picks, trade recommendations to model portfolio updates, sort of strategy, commentary, and you can check out all of that for free on my Substack, which is paulmantili.substack.com. All right, let me quickly go to what I'm talking about, because sometimes a picture is better than really going on. So, yeah, you look at this, right? I mean, you see this this expose from Michael Burry Stock Tracker, and he says mega cap tech stocks are currently surpassing the small cap stocks by the widest margin ever recorded, folks, ever recorded, even exceeding the peak of the dot-com bubble. And I mean, those of you who can recall that, and I was around for that, I mean, in that time, the Magnificent Seven were called, I believe it was called the Fearsome Foursome. And if memory serves me right, it was Cisco, Dell, I think Oracle, and Sun Microsystems. I mean, I may have gotten wrong. For sure, Cisco was one of them. Right? Cisco was like the superstar stock that, I don't know, traded 60 times earnings, something like that. And yeah, all the small stocks were just left for dead. Not that different than what is going on right now with the market of stocks. I should just correct that. The market of stocks. Many people talk about the stock market, and I mean, it has now become so much a practice of how we think about the market, talk about the market, that we forget that there is actually a market of stocks. There is something more than the S&P 500. For sure, the vast majority of money just goes in and buys the index, and you know what? God bless them. Yeah. And they've had a really good run. And the thing is that eventually all runs end. And it's usually for a number of reasons. I mean, one is that eventually things just get to a point, whether it be valuations, whether it be demand and supply dynamics, or something that just surprises people in the condition of the companies, and that then causes this shift. And that's, something like what happened in 2000, 2001. I mean, the case for Cisco back then was bulletproof, no different than the Magnificent Seven, as it's being called, which I believe is what? Apple, Microsoft, Amazon, Meta, Alphabet, which is Google, and I think Tesla, but Tesla's kind of like a stepchild to this because, there's a lot of people that still hate it. But the arguments for Cisco and Dell in 1999, 2000, yeah, very reminiscent of what you are currently seeing with this Magnificent Seven. So I'm just going to go back and share that same screen again. because I did a X search for small cap stocks, right? And it came up with what you're seeing. So that chart showing that, small cap stocks versus mega cap stocks, yeah, they're at a enormous, extraordinary peak relative to small stocks. Here's another one from bar chart showing essentially the same thing. And this is an account that I follow a lot, Charlie Bailello, and he shows you that generally liquidity has flown to the biggest stocks, which are up 20%. And I have talked quite a bit about how I believe it's 7 stocks. I think, sorry, the top 10 stocks in the S&P 500 represent about 31%, maybe it's 32% of the S&P 500. So you got 10 stocks representing 30% of the S&P 500. You got 490 on the other side that represent 70. But the top 50 actually, represent, I think it's like something close to 60 or 65%. I haven't looked, right before getting on, but it is an extraordinary level of concentration that, based on past history, has usually been followed by some form of a reversal in terms of the money flow. And when I was managing money, we would say, you'd sell a stock, for 3 reasons. One is that you just got some part of the analysis wrong. I mean, it becomes clear that you made a mistake in understanding the business. You made a mistake in terms of, what they were going to do. So that's a mistake. And you would just pretty much, the moment you realize that, you sell it off. The other one is where, a stock gets to a point where, look, it's as good as it gets. I mean, what more could get better? And stocks sort of signal that to you by valuations. They signal that to you by how popular these stocks are, how beloved they are, how unwilling people are to sell them. And then, this word valuation comes up. And, this tweet from Brian Stoffel appealed to me because it shows that, hey, well, the big stocks, yeah, their valuations have just kept going higher. And yeah, the small cap index, the Russell 2000 index, yeah, it's been chopped in half. So, and then the last reason why you'd sell something is because you find something better. And where I believe we're at the point where, look, the stock market is not made completely of lemmings. We're not all sheep. At some point in time, some number of asset managers are going to be like, look, yeah, I mean, this is an incredibly popular trade. There's this Magnificent Seven movement. At some point in time, small amounts of money are going to start to filter out. And even those small amounts of money are required to keep these stocks at fairly high levels. So sooner rather than later, in my opinion, my judgment, I mean, we're going to see this reversal unfold. And that's going to be great for smaller companies, but it's still going to be smaller companies that really still fit to this new bull market, which is that this new bull market is not about investment demand. What's investment demand? It's where really, like, low interest rates kind of stimulate very speculative kind of buying. No, I mean, that market is over. That bull market is over. We're in a new bull market, which has just generally higher standards. I mean, interest rates were 0%. So when interest rates were 0%, you could justify almost anything. I mean, for some period of time during the last 14 years, interest rates were almost negative, right? So in that scenario, even a plus 5% asset that is cheap enough, you could lever it up, you could borrow. If you're borrowing at 0 or -1 effectively, and you lever up 5%, you can manufacture massive returns, but you cannot do that in a world where interest rates are 5.5%. You just cannot do that. From here on out, yeah, I mean, the companies, the stocks, that are represented by the companies, I mean, they've got to meet the benchmark. They've got to meet a hurdle rate, which is like, hey, to deserve new capital, to get a new shareholder, you have to project, you have to be able to convince, persuade, show by something. I mean, obviously, growth companies, their growth is into the future. So you can't be like, well, where's all the growth right now? No, I mean, innovation takes a little while to be figured out. But if you can show a clear pathway for your growth, and it has to be, this is a judgment call on my part, I'll say 10% minimum, 10% minimum, like, going forward, preferably 12 or 15%. I mean, 12 or 15%, you'll get huge investor money. Again, a clear pathway to growth. In other words, you've shown the value of your product, you've shown the value of your service, you've shown that you don't need to subsidize your customers and your clients to continue to get the business. In other words, you have to be able to charge something and people are willing to pay for it. You have to show that also you have a path to sustainability. What's sustainability? In other words, you don't need to put your hand out to investors constantly and say, hey, buy my stock. Hey, buy my convertible bond, which is going to turn into stock. In other words, no more continuous, non-stop, asking investors for more money, because the underlying rationale basis for your business does not exist. In other words, take out the subsidy from investors and hey, nobody wants to buy your product. So you got to show that you have a sustainable business. Just no different saying you got to run a profit. I mean, you got to show some pathway to a profit. So not just any small caps will do. I mean, you got to fit this. And the last one that small caps have to deal with, which is that I would say, especially tech and growth tech, the managements of these companies have had a blank check for 30 years. Hey, stock options, no problem. Hey, we'll dilute the stock by, 15, 20%, etc. Yeah, I mean, what we have seen in the last 2 quarterly results is that the stock market is selling those stocks and hitting them really hard. In other words, you got to show some capital discipline. You cannot be continually inflating the number of shares that you have. All the way until really like a couple of years ago, the number of shares that a company had, investors largely ignored it, and companies used to say those were non-cash expenses. But partly as a result of a accounting ruling, these are now being counted as cash expenses, because you know what? They always were cash expenses. Because what did the employees do once they got these stock options turned into cash? Well, they turned around and they sold them. So while it wasn't a direct cash expense, it was always a cash expense. Now the market is absolutely dinging stocks for it. So what's the bottom line for this video? Number one, we're at a extraordinary kind of extreme, a different kind of extreme than what we had in the year 2000. That was like a bubble driven around tech. Today, we've got massive concentration in the S&P 500, where 7, 10, at most 20 stocks are getting almost all of the money. And you've got all the other companies that have gone through horrific crashes. I mean, there's just so many stocks that are down 70, 80, 90%, get no liquidity. In other words, you can have a stock report fantastic growth and its stock will still plummet. And that's just because there's no support. Nobody is willing to come in and buy. Now, what will exactly turn that around? Well, it's going to be some mix of what I've said, which is that there's plenty of smart money and there's plenty of dumb money in the market. And the smart money is aware of these cycles. They're not clueless. They see the same charts that I'm pointing out to you. And what do? Well, they're like, hey, let's start to make an asset allocation shift from a large cap to small cap. And hey, given where small cap is, even $1 billion or $2 billion, which maybe sounds like a lot, but remember, the world of assets is worth hundreds of trillions of dollars, right? So $1 billion or $2 billion is not, but you see those going into names and stocks that right now are just there's just 1 million shares being traded. You start to put $1 billion or $2 billion or 10 or let alone 100 billion. Now that will stimulate a bull market. So I know that sounds fuzzy wuzzy. People like precise facts. The thing is that you always know all of that much later. Later on, be like, oh yeah, it turns out that whatever XYZ Genius Investor, XYZ Asset Management Company, they had asked allocation shift, and it was brilliant. Everybody should have done it. Well, I can tell you that, yeah, in my opinion, is given the price action of the stocks, given just the absolute brutal hammering, and also the disconnection between a company's prospects and the stock price. Yeah, when you see that disconnection, in other words, you see companies are experiencing significant growth, they're profitable, they're also showing capital discipline, and they report great earnings and the stock goes down 10, 15%. Yeah, that's a sign of a market that's, about to go in a different direction. And if you want to check out and find small companies at ATG Digital Media, you'll find them in our gold and silver tiers. And next week, I'll come in and actually I'll follow up on 3 small cap. They're now micro cap stocks that I talked about nearly 6 months ago when the early signs of this were unfolding. So come back for that next week. Oh, yeah. Don't forget this. Thanks. This is Paul saying bye.